Welcome back to the Bitcoin Layer. I'm Nik Bhatia. Today we welcome Steve Miran. Steve has worked in the Treasury Department. He's also a PhD economist. Steve, welcome to the show.
Thanks. It's great to be here. Thanks so much for having me.
Okay, Steve, so give us your background, how you ended up at Hudson Bay, where you currently are, and your trek through the government.
Sure. So I'm an economist by training. I have a PhD in economics, and decided not to go into academia after finishing my doctorate, and went into the investing world. And I was an investment professional for a long time, and then sort of had wanted to go into the administration for a while, but was too engrossed in my career. And then COVID happened, and I said, "Hey, this is the moment at which government absolutely needs foot soldiers." And I found myself at Treasury during the pandemic, helping with the variety of fiscal and financial government responses to the pandemic recession, which all told together, sort of was the largest fiscal programs in world history. And it was really, in a lot of ways, a wartime treasury, sort of working around the clock to try and prevent the country from slipping into a depression. I think we were very proud of the work that we did, making it the shortest the shortest recession since the 40s, the fastest and strongest recovery. We were very, very thrilled that the country was able to avoid the worst economically speaking. And then after coming out of Treasury, having a background in the economics of fiscal policy and public policy, kept on writing in that in that subject area while going back to work as an investment professional, and that combination has allowed me to pursue my work in the investment world at where, as you mentioned, I'm a senior strategist at Hudson Bay. I also do a lot of policy writing. I'm also a fellow at the Manhattan Institute, which is a think tank here in New York City. And I try my best to think about how those two often can intertwine with each other, as they very much do from both a fiscal and monetary perspective, which gets at a lot of the issues that I think your listeners are interested in these days.
Yes, and I'm probably most interested in the dollar and the level of the dollar versus other currencies more than anything, but not just the level of the dollar itself, but everything that will impact throughout the global economy, and specifically financial markets, risk markets, etc. So, Steve, why don't you talk to us about, let's start with Trump's return to the White House here in a couple weeks. What is your overall outlook for the tariff policy? Because I know that you are suggesting that tariff policy is what will start, and then we'll get ramifications and the impact on the dollar after. But where are you seeing the administration go with tariffs?
Sure. So let me start off by disclaiming that everything I say is, my personal opinions and my personal views only. I don't speak for the views of Hudson Bay Capital. I don't speak for the views of any other institution. I don't speak for the views of the Trump-Vance presidential transition or anyone involved in the incoming administration. My opinions only, for whatever that is or is not worth. Look, I think that President Trump ran a campaign in large part on, not exclusively on, obviously there were many issues that mattered, but one of President Trump's signature issues is a desire to restructure the global trading system. And given the magnitude of President Trump's victory at the polls, in both the Electoral College and the popular vote, I expect him to follow through on that. That has been not only a signature plank of his campaign, all three times he campaigned for president in the last decade, but it's also a consistent view of his going back many decades. If you listen to interviews of his in the 80s and the 90s, he hits many of the same themes about the structure of the international system and the United States position within it, and the need to secure fairer, better deals for the United States. And the way I conceptualize this is that the United States provides two very important things for the world. It provides reserve assets, which facilitate global trade. You couldn't have global trade without a reserve asset, or it would be much more expensive. There'd be much less of it. And it provides security umbrella that keeps, by and large, the world pretty peaceful. Yes, it's become less peaceful in the last few years. But by and large, the world is in the scope of history, it's still pretty peaceful, thanks to the United States. Now, providing those two things are expensive. They impose burdens in the United States. We pay taxes to provide the defense umbrella, and in terms of providing reserve assets, it pushes up the value of the dollar, which of course creates problems for our manufacturing sector, problems for our tradable sector, which leads to sustained trade deficits over decades that President Trump has very rightly focused attention on, and that many of his supporters have decided it's done. It's too much. No more. We want to sort of put the American worker and American manufacturers and American firms on better footing vis-a-vis the rest of the world. And so there are costs and benefits of all of these things. And I think, the most important thing that I take away from President Trump's victory at the polls is a real clear democratic mandate for not for junking the system, not for throwing the system overboard, but for improving it and making sure that he secures a better place for America in the context of this overall global trading and financial system that provides much better burden sharing with our trading and security partners to reduce the cost of those burdens in the United States and help other countries do a better job pulling their weight.
The Bitcoin Layer is sponsored by Unchained, the undisputed leader in Bitcoin financial services. Unchained empowers you to take full control of your Bitcoin with collaborative multi-sig vaults, in which you own 2 of 3 keys and you gain a Bitcoin security partner. You can purchase Bitcoin directly into your cold storage via Unchained's trading desk and eliminate all exchange risks. Unchained also offers the best IRA in the industry, where you can convert your existing 401ks or retirement accounts to Unchained, all while keeping control of your Bitcoin private keys. Don't pay more in taxes than you have to. Talk to Unchained today. Go to unchained.com/TBL for $100 off when you sign up. Don't risk your Bitcoin security. Do you have Bitcoin private keys stored on paper? Make sure you convert those keys to titanium with Stampseed. Stampseed has this really cool DIY kit that allows you to hammer in your seed phrase into these small titanium plates that are fire resistant and damage resistant. This kit is designed by titanium metal workers that have been working in stamping metal for over 14 years, and your words are deeply stamped, not just a shallow dot. So make sure you check out stampseed.com today and use code TBL for 15% off of your order. Steve, I have 3 charts here that you can reference from your paper in this answer. So I have your chart on manufacturing employment and the decline of manufacturing employment relative to the size of the labor force. I have the US share of world GDP as well. And then I have the United States current account. And we can see that, the current account, slipped into a more negative position here over the last few years after a little bit of recovery during the 2010s. My question to you is, the US, or we hear the administration, they want to revive American manufacturing, and we hear a tone of a weak dollar, of wanting that weak dollar to relieve ourselves of this overly strong dollar due to, like you mentioned, the fact that the US dollar is the reserve asset of the world. So what can be done to actually weaken the dollar if at the beginning we get manufacturing tariffs to try to bring back some of that manufacturing that's going to strengthen the dollar? So walk us through how we should be thinking about the policies.
Yeah, sure. So first, up front, I don't get the sense at the moment that President Trump and his advisors really want to weaken the dollar. There's been a lot of talk about the importance of the dollar as a reserve currency. It allows us, it gives us a variety of benefits. Among those are, sort of the ability to borrow greater amounts without sort of pushing up yields. Among those are the ability to engage in what I call financial extraterritoriality, the ability to impose sanctions and bring financial devastation on geopolitical and security enemies without moving a single soldier across the world. And those are very powerful benefits. And And it sounds like, and I think that President Trump and his cabinet and his advisors will ultimately decide what it is they want to do. But based on the recent conversations they've been having in the press and publicly, it doesn't seem to me that they're interested in the very near term, at least, of weakening the dollar for fear of upsetting, for concern of upsetting that apple cart. Now, when you think about sort of adjusting the global system again, this is sort of my views and my framework for how I think about it. When you think of adjusting the global system to improve burden sharing for the United States, there's two ways to do that. You can pursue a weaker dollar to improve the terms of trades for American firms and workers, and reallocate manufacturing and export demand from other countries to the United States. American goods are cheaper to produce, and so we'll sell more of them. We'll have more demand and more jobs. Or you could pursue tariffs, which raise revenue. And tariffs, in my view, and we can get into this if of interest, but my view is that tariffs are ultimately the economic burden of tariffs, what economists call the incidence of a tariff, is ultimately borne by the tariffed party, the tariffed country. And so and that raises revenue, which comes into the Treasury, which in large part actually helps finance lower taxes on Americans. And so if you think about what happened in the first Trump administration, we raised, over about a 10-year budget window, we raised roughly $500 billion of tariff revenue from the tariffs on China from the first round. And that's with significant tariff evasion from China re-exporting stuff through Vietnam, through Mexico, through other places, that I think the next Trump administration very much should crack down on, and I expect them to crack down on it. So, let's just say $500 billion over a 10-year budget window. The original scored cost of the Tax Cut and Jobs Act of 2017 was $1.5 trillion. So combining those two things, the China tariffs financed about a third of the overall tax cuts that were provided for American firms and workers that make American production much more competitive. It's much easier to employ American workers when tax rates are low. It's much easier to engage in investment when corporate tax rates are low. And so it's a huge competitiveness advantage for U.S. production in the form of lower taxes, financed by the tariff revenue, whose economic cost is, in my view, very clearly borne by China and Chinese producers and consumers. And so you can there are multiple ways of pursuing more competitive American production. It could be through the currency channel, or it could be through tariffs.
And so we want to understand now how the US is going to basically deal with the stronger dollar. So and I hear you loud and clear. The reason that I suggested that they might want a weaker dollar is that we heard Vance talk about the exchange rate and the competitiveness. So, but the rhetoric that we are hearing out of the administration, as you are saying, is pro-dollar and it's pro-U.S. reserve currency. So does the strong dollar penalize the world economy? Does that feed back into the U.S. as a tighter financial condition on the world? Does that have the potential to bring down inflation, which is going to be good for the administration and their efforts to have a good election result in 2026? And then, or does a strong dollar knock down the world economy or make U.S. less competitive to the point where it has a detrimental impact? So I'm trying to understand really how it plays out. Is a strong dollar good or not that good, or good for a little bit, then they have to weaken it? And you can also mention in your paper, you said that the Fed can help in getting policy where they want. So is the Fed independent? And Steve, I found your work over the last couple of years because of your articles about how Yellen is manipulating Powell with her bill issuance and the not QE and the running down of the TGA and all of that. So these are all concepts that we've been following you, working on ourselves and trying to understand. So we're excited to get your expertise here.
Thanks. So look, with the dollar, I would say it's overall, it's very nuanced, right? And it's a matter of how much, right? And I think that there's significant nonlinearities, and some dollar strength is, going to be disinflationary because it lowers the price the price of imports, and it's probably good. It's probably good for other producers because their goods are more competitive. For other countries because their goods are more competitive. At the same time, if the dollar strengthens too much, then you do lead into tighter financial conditions in other countries, the way that you described before, and then they start to suffer. But nevertheless, I don't think that policy in the United States should be set with concern for what the global economy is doing and what the economy and other exporters is doing. I think policy in the United States should be set purely for the sake of improving the welfare of American workers and firms and families and consumers. And when you sort of think through it like that, you have to say, okay, the stronger dollar provides some benefits to the United States and it provides some cost to the United States. And how can we think about improving this cost benefit trade-off from an overall perspective? And very much, I think that's where tariffs come in. My view, as I wrote in the trade paper you mentioned before, is that tariffs are generally speaking offset by moves in the currency market. And so if you look at what happened in 2018, 2019, we imposed roughly a 17 percentage point increase in the effective tariff rate on China, and the dollar appreciated by 15.5% from its low to its high against China over this period. In other words, the move in the currency almost completely offset the increase in the tariff rate. The imports become cheaper because the Chinese renminbi weakened. The imports became more expensive because the tariffs went on them. The two effects almost perfectly cancel each other out. And there's a lot of nuances around exactly which goods, and sure, you have relative price changes, and these goods became cheaper and those goods became more expensive. But I think over the long run, sort of currency values matter, and those two phenomena serve to cancel each other out. And you didn't get a dramatic increase in prices experienced by U.S. households, which is why there was no discernible rise in inflation over that period, no discernible drag on GDP growth over that period. What you did get was revenue into the Treasury. So there's no real material change in relative price in the United States. Treasury's taking in all this money because of the tariff revenue. And at the same time, the Chinese are poorer because their currency is worth less. The purchasing power of their currency has gone down. The incomes of the workers is worth less in terms of purchasing. The revenues of the firms is worth less in terms of the owner's ability to consume. And so you have a situation in which you get sort of significant no material changes in prices that lead to inflation or growth drags here. Treasury gets revenue, and China is poorer as a whole because their currency is weaker. And that to me sounds like a pretty good bargain. Economists think of this in another way. There's a big literature in the public finance literature and economics of what economists call incidence, which is who bears the economic burden of the tax. And in general, economists believe that a tax, it doesn't matter who pays a tax, whether if you put an income tax on a worker, it doesn't matter whether the worker pays it to the government or the firm pays it to the government. The economic burden of the tax is independent of who actually remits to the government. The economic burden is a function of the relative elasticities. And the person who has more flexibility to adjust his or her supply or demand of a good or service is able to change their behavior to avoid the tax. And so if I'm, pretty elastic in my labor supply, and then the government jacks up my marginal tax rate, and I say, well, I don't really have to work those last couple hours. I'd rather sort of just stay home and have more time with my kids. Then I can cut back on my labor supply, and the firm has to then go out and pay more to find someone else but the firm really needs me to produce. The firm has to pay more to go out and find somebody else to spend those couple hours at work. So in a situation in which I'm very elastic, but the firm isn't elastic, the firm will end up bearing the economic cost of the tax. The more inelastic person bears the economic burden of the tax. And it may be the reverse. It may be that the worker is more inelastic because they really need the dollars to pay for their family. And the firm sort of views, and the firm doesn't view them as that productive. And so is sort of, not so interested in replacing the worker. Economists believe the more inelastic person bears the tax. Now, when you think about this in the tariff context, installed capital in China is very inelastic. It's installed, designed to export to the United States, designed to export to the U.S. consumer market. And if you put a tariff on, they can't adjust. That sunk costs, that capital is in the ground, those factories are built. U.S. consumers can be, on the other hand, quite elastic in terms of what they consume and where they consume it from. So my view is that tariffs are absolutely borne by the tariff country. In particular, China, in particular tariffs on China. And so I think that's sort of a great solution for improving, as I said before, burden sharing in the global trading system. But did you also want to talk about the Treasury stuff and Fed
Yeah,
stuff?
we'll get to that. Now, my next question is tax cuts. We're going to see, hopefully another round of tax cuts from the administration when they come in. How big can the tax cuts get, and what are some of the ideas there? And then another question on policy is, are there going to be favored industries for reshoring, industrial policy, energy policy, electrification policy, AI, compute? Are we going to see any of that explicitly from the administration alongside those tax cuts at the beginning? What's your explicit policy outlook on those two fronts?
Yeah, sure. So I think that President Trump knows that the economic boom, the non-inflationary economic boom in his first administration, was due in very large part to tax cuts. He is determined to have another non-inflationary economic boom in his second administration, and the boom in the second administration will very likely also be due to tax cuts. That means, first of all, extending the vast majority of the Tax Cuts and Jobs Act. It also means potentially more tax cuts at the margin for different types of taxes. President Trump has discussed a variety of those on the campaign trail, stuff from tips to overtime, Social Security. He's also discussed tax cuts to the corporate rate even further, which makes America a more competitive place to do business, a more competitive place to invest in production and hiring workers. And I think you could see a variety of motion forward on those fronts. I think folks are starting to get to work on those areas now. They're starting to game out how the reconciliation process is going to work through Congress, what Congress's red lines are going to be for passing these variety of potential tax measures. And I think that you're going to see these negotiations start to happen in pretty real time as we sort of approach the holiday break and then into the new year, right up to inauguration, because I know that folks want to get started as soon as they can after inauguration. So they're starting to do some work in the run up to that. And I think there's great sets of candidates for thinking about how to provide further relief on the tax front. As far as industrial policy goes, I think that industrial policy isn't really good. Isn't going anywhere. I think that industrial policy is here to stay. I think is going to be rechanneled from sectors and industries that Democrats place high priority on to sectors and industries that Republicans place high priority on. And so, for example, the way that I think about the Inflation Reduction Act is that it was a huge, $1 trillion plus industrial policy bill, but that ultimately didn't achieve, I think, what its stated primary aim was, which was to improve the climate situation of the for the outlook going forward. And the reason is that the vast majority of increases in emissions come from China and come from the rest of Asia. And if you take the Biden administration Department of Energy's estimates for how much the reduction in carbon emissions from the Inflation Reduction Act and the Infrastructure Investment and Jobs Act, the two major Bidenomics programs that dealt with industrial policy, and you look at the annual increase in Asian emissions and the trend line in history there, and you extrapolate that trend out, the entire reduction in U.S. emissions was offset by increases in Asian emissions, primarily Chinese emissions, in, I think, like 20 months, 20 months, right? So if you think that your primary concern is that there's going to be some sort of climate catastrophe in 2100, and you sink trillions of dollars into your signature industrial policy, pushing out that climate catastrophe from 2100 to 2102, that doesn't seem to me like a very successful. Meanwhile, causing huge inflation, crowding out, pushing interest rates higher. People can't afford mortgages to buy homes because interest rates go high. That to me doesn't sound like a very effective policy. So I think Republican industrial policy will look very different, and I think that it's going to be focused primarily at strategically defense, national security priority industries. What does that mean? That means some of the ones that you mentioned. It means AI. It means certain manufacturing that feeds into the defense supply chain. It means certain elements of pharma and medical supplies that you don't want to be reliant on China if we should have another epidemic. They talk about bovine flu and bird flu, and I'm not a biologist, so I don't know how important these things are. But nevertheless, we just had a big pandemic. We might have another one, and if that ever, there's some probability that we do, and if that were to ever happen, you don't want to be reliant on China's goodwill for critical medical supplies. It's just not a situation you want to be in. So I do see continued industrial policy, but I see it focused more at sectors that Republicans deem critical for national security, and less at areas like climate that Democrats are more concerned with. And I think that Republicans would sort of say it didn't do any good. It's one thing to say you want a big industrial policy for climate if you could actually solve the problem, but the problem is pretty intractable without changes in behavior from China.
What about rare earths? So this is something that I don't believe that the U.S. can just reshore. Does the U.S. have to keep friendly relations with China for certain industries, for the import of certain materials like rare earths, or not?
Yeah, I mean, I don't. I'm not an expert on this type of thing, but my understanding, such as it is that we do have lots of rare earths in the United States. It's merely a matter of being able to retrieve them in a way that's compliant with our environmental regulations, and that if we really, if push came to shove and we really were determined to do so, we would find a way of doing so that we're better in compliance with EPA regulations.
Let's talk
I think also there was an
ahead.
episode in which China cut off rare earths to Japan, and I think what Japan did was they started recycling them, right? So they started taking all these old Walkman and Discman and walkie-talkies or whatever, like old equipment, and it's apparently and again, I'm not an expert in this, so I may be saying something that's completely wrong, but my understanding is that it's relatively straightforward to salvage rare earths from old electronics. And maybe that's no longer the case, or the rare earths that we need now are different, or the electronics have changed. But I don't worry about that. I don't worry about that too much.
So let's talk about the Fed now. The independence of the Fed is now, let's just say it's the topic du jour with Trump coming back. Give us your outlook. Is Powell going to stay? It sounds like he's going to stay. How does Trump get Powell to do what he wants? Is that something that he wants, for Powell to follow, what Trump says? I'm curious what your outlook on the Fed.
Sure. So this is an area where I think I've been certainly a bit heterodox relative to a lot of other economists, and I think that people overplay the extent to which the Fed has been independent. And as we talked about before, the paper I wrote with Nouriel Roubini on activist Treasury issuance and how that's really hijacked some control over financial conditions from the Federal Reserve. I think there's also enormous personnel overlap between the Fed and Treasury. And so Jay Powell, used to be an undersecretary for domestic finance at the Treasury. And then if you look at the Biden administration Treasury Department, the entire line down from Janet Yellen, Undersecretary of Domestic Finance Nellie Yang, Assistant Secretary for Financial Markets Josh Frost, those are all former Federal Reserve officials, right? And so there's a huge amount of overlap and a huge amount of coordination. And then you look at guys like Austin Goolsbee, right, who was the co-chair for economic policy for the Biden campaign in 2020, or someone like Lael Brainerd, who goes from on Friday she was vice chair of the Fed, and then on Monday she's the NEC director for President Biden. So in general, I think that people overstate the extent to which the Fed is already truly some cordoned off, fully autonomous institution. It's not. That said, I think that things are going to de-escalate with the Fed, because the Fed is about to get a much better partner in setting policy. And so for the last 4 years, fiscal policy and issuance policy from the Treasury from the Treasury Department have all been slamming on the gas, even as the Fed was trying to hit the brakes on the economy. And when you keep on running huge deficits and you keep on throwing more and more stimulus, and then you keep on creating new loopholes to increase the size of those stimulus programs, and the way that the Yellen Treasury has, sort of decided to count $75,000 luxury sedans as SUVs so that they could qualify for taxpayer credits, for $8,000 taxpayer credits on the Inflation Reduction Act, or expand the definition of trade agreements that you could count certain parts from countries that the bill was written to intended to exclude imports from. Or the games they played on the definition of leased vehicles versus bought vehicles. Just they've taken all sorts of steps to try and get as many dollars out the door as possible through the Inflation Reduction Act, which is why the bill was originally scored at like $300 billion or something, and now it's scoring at like between one and a half trillion, depending on who you talk to, and maybe that that estimate would keep going up if the Trump administration didn't try and reverse it as they come into the administration. Now, I think that you've had it, and by the way, and that's just the demand side stuff. Then you've got the supply side stuff as well, with all the regulatory apparatus and the way the regulations crimp the supply side and prevent the dynamism on the supply side, prevent the building of new stuff, and make it more difficult for the supply side to respond to fluctuations and shifts in demand. And I think all that's about to change. The Trump administration is going to pursue cheap energy, abundant energy policy, which is very, very disinflationary. The Trump administration is going to pursue a heavily deregulatory agenda, which is very, very not just disinflationary, it's outright deflationary. And the Trump administration has indicated that it's going to pursue smaller deficits over the course of 4 years. Secretary Designate Scott Bessent has indicated he wants a 3% deficit, which is a big reduction in the size of the deficit by the end of President Trump's next term. And so you put all those things together, and I think that the Fed is about to get a much better partner in actually reducing inflation than it has had for the last 4 years. So if anything, I expect tensions to de-escalate rather quickly.
So, Steve, when we had Trump come in 2017, he wanted a non-inflationary growth boom. He got it, but he didn't have the inflation lurking in the background at that time. Now he does. So, is he going into office? And I'm glad you brought up Bessent, because that my next question was about him. He wants the deficit down because he understands that the deficit is inflationary, and he wants to get inflation down so that they can get reelected. Is that at the top or near the top? Because we know, this pro-America policy has been what he's campaigned on 3 times. He did it again. It's a pro-America policy. But where is the anti-inflation policy relative to his pro-America policy as he comes in, trying to basically get more support in 2026 potentially?
Yeah, so this is where I think deregulation comes in, and I think deregulation is extremely powerful and extremely underappreciated by economists, and it's underappreciated by economists because it's difficult to study. Taxes are easy to study. It's very straightforward what a tax is. I could tell you my marginal tax rate is 15 or 28 or 35% or whatever it is. Everybody can sort of it's not always so straightforward, but it's much more straightforward to identify what tax rate people face. It's much, much, much more difficult to identify what regulations people face because there's so many of them. They're so heterogeneous. There's many different jurisdictions. Many of them are enforced with varying degrees of severity and activity from the regulators, and they are difficult to quantify. Right? It's very straightforward to quantify a tax. It's very difficult to quantify a regulation. And so as a result, economists in true, looking where the street lamp is shining form, underappreciate the extent to which regulations are important. But just think about something like zoning, right? And imagine, you just just as an example for illustrating the point, imagine you just abolished zoning. And then suddenly, in a place where there's only 1 acre lot, single family homes, you could start building, little, 5-story multifamily apartment buildings. The price of housing would go down, right? It's not just disinflationary, it's outright deflationary because you're increasing supply of stuff. You're allowing the economy, you're allowing the private sector to provide more of the stuff that consumers want. And if you can build factories quickly, if you can build infrastructure quickly, if you can build housing quickly, and you can produce quickly in all these places, then that's a big advantage. And that's as I said, not just disinflationary. It could be outright deflationary, depending on how it's done and how rapid these effects are. And I think that's going to be extremely powerful. And I think people really underappreciate that. And it's really crazy to me that people underappreciate it, because they just spent, especially I think, many of the more liberal economists just spent the last 3 years, howling about supply constraints. And then at the same time, they took every step they possibly could to increase regulation and make the supply side of the economy less responsive to demand, and harden those supply constraints rather than trying to relax them. And I think red tape is a big barrier to production. It also encourages consolidation, because every regulation costs compliance. It makes you do compliance costs, right? And if you, in some heavily regulated industries, if you want to start a small business to do some activity, you got to spend tens or hundreds of thousands of dollars on compliance to comply with the various regulatory authorities. And that's really expensive. And it creates economies of scale, because bigger companies are better able to handle the regulatory costs of compliance. That encourages consolidation. It encourages mergers and acquisitions. It reduces competition, and it increases prices. Every regulation is a barrier to entry. Every regulation reduces competition. And I think that it's profoundly underappreciated, and was a significant portion of why we had a disinflationary boom in the first Trump administration, and why I expect a disinflationary boom in the second Trump administration.
Does the fall of the Chevron doctrine change the game from your perspective, Steve?
I don't know that I would describe it as changing yeah, probably. Well, let me first say that I'm not an attorney. I'm just an economist. Nevertheless, I think it is a bit of a game changer. I don't think it's it's not a huge game changer, because there's still lots of other stuff that regulators can do. But I do think it really accelerates the capacity to deregulate, and I think it sort of puts the courts at the backs of as a tailwind at the back of the administration, as it tries to slash regulations. I think it's going to be a powerful tool. Yeah.
Where are we going to see some of the attack against existing regulations that can boost economic activity right away?
Yeah, so one area that I think is going to be important to a lot of your listeners is, I think, financial regulation is excessively burdensome and prevents banks from lending into the economy as much as they would. And I think sometimes can really inhibit innovation in areas like the crypto economy. And I'm a huge believer in innovation, in powering the betterment of mankind and increasing prosperity in ways that nobody can really anticipate ex ante. And you can always sort of be a little bit surprised at how things turn out. People don't predict how an invention like the internet or crypto or ATM or radar or whatever is really going to change the world. And yet things can develop in ways you don't expect. And so I think that financial deregulation is going to be a powerful part of that. I think that crypto has a big role potentially to play in innovation and ushering in another Trump administration economic boom. And we'll see what happens with that. I think it's also really important to deregulate on the capacity to build stuff. I think we want to build everything we possibly can in this country. We want to build housing. We want to build factories. We want to build infrastructure, and getting rid of all of the regulations that prevent that from happening, simplifying permitting processes, putting time limits on permitting processes, encouraging harmonization and synchronization between the various layers of government, from localities up to the federal government, for all of this stuff, I think is of critical importance. Because if you want to make stuff in America, you have to be able to build the stuff to make the stuff in America. And I think reforming the regulatory apparatus in those realms is going to be of critical importance.
Steve, I want to ask you about Besant. We had Michael Howell on recently, and he had a working thesis that the Yellen activity of keeping issuance in the short end of the curve, basically a lot of bill issuance, kept longer term yields from rising, as you basically didn't have that supply hit to the market. We had that one QRA announcement with the large increase beyond what was expected, and that did steepen out the curve. So even though that has been basically manipulating the monetary policy from the Treasury side of things, that longer term yields not going up is a good thing for risk markets, because you don't have this crowding out effect or the discount rate going up and hitting the present value of cash flows. So does Besant continue the Yellen policy of issuing a ton of bills, even though he might be politically opposed to the way in which it was rolled out? Is that relevant, or how are you thinking about this?
Yeah, so I think Secretary Designate Besant will tell us that hopefully soon, once he takes office after January 20th. My expectation, and again, this is sort of just my own personal view about what I expect. I don't think that he would take a very dogmatic position of saying, I'm going to term out these bills on day one out of principle. Because of fear that sort of a rash, very fast action like that could upset the bond market. And as you say, upsetting the bond market can upset risk markets in the economy. So I wouldn't expect a dogmatic insistence on term out on day one. Rather, I would expect him to formulate a plan to accomplish a term out over a longer period of time, potentially, looking for a right opportunity to do so. I think that Secretary Yellen has done a great disservice in leaving what is essentially a time bomb of bills to term out for her successor. And I think that it would be foolish to detonate that bomb while your face is in it. You want to try and diffuse the bomb safely before trying to get rid of it. So I would expect term out at some point. It's certainly a big problem. Even the IMF is critical of it. Even the IMF is flagging the risks from excessive short-term borrowing in their financial stability report. I expect a term out to happen. I don't really have a good idea of exactly when that happens. Does it happen in the, over the course of the first year? Does it happen over the course of 4 years? Does it happen when there's an opportunity? Suppose that the Trump administration is successful in getting energy prices down, and deregulation and tax reform are extremely deflationary, and then interest rates are much lower a year out. That would be a great time to do it. Yeah.
Yeah, well, one of the things that governs us at the Bitcoin layer is we're a price-focused entity. So instead of trying to say our narrative and then confirm it with the price, we go with the price first, and then you try to describe what's happening. So
Yeah.
when yields were increasing from the months of October before the election, as Trump return was getting priced in, and then his election, yields kept going up on this worry that we're going to have these huge deficits, huge tax cuts, and it's going to be inflationary, or that Trump is going to put inflationary policies in there. Well, look, yields basically tagged their declining resistance, and they've marginally trended lower since. My question to you is, was the Trump 2.0 trade, in which yields were jumping quite quickly, you had bond volatility coming back into the market, was that overdone? Are we going to be going forward next year with rates basically here or maybe slightly lower, or do we have to worry about higher rates next year?
Yeah, so I think that the Trump trade, as you just described it a moment ago, with higher yields into and after the election, was a result of the market wrongly believing that President Trump is going to be cavalier about expanding deficits, and what's a 7% deficit now is going to become a 10 or 12% deficit because he just wants to issue deficits to cut taxes, and rather than find pay-fors for the tax cuts that he wants to pursue. I think that's wrong. And I think that, look, Scott Bessent has, as we said a moment ago, focused on trying to get to 3% deficits by the end of 2028. And that has helped turn the bond market, because President Trump is appointing economic advisors like Scott Bessent, like Kevin Hassett, who's going to be the NAC director, who are cognizant of the dangers of too much deficits and too much debt and too much borrowing. And President Trump has indicated, sort of his desire to follow their advice and to avoid upsetting the bond market. So I think that a part of the rally is in part because of that. I think President Trump is somebody who is very respectful of the power of markets. very respectful of the power of markets, and he's very smart and savvy about financial markets. And I don't think that he is going to pursue policies which are going to really, which would upset the bond market. I think the bond market will ultimately find this administration very reassuring. If interest rates do move higher, in my view, it'll be because improvements in the potential growth rate due to structural reform of the regulatory code and tax cuts. And if we successfully engage in further tax cuts and preserving low tax rates, we successfully engage in slashing the regulatory burden on firms in this country, we can improve potential GDP growth. We can improve the supply side. We can improve longer term growth. And that's actually, that could be positive for interest rates. That could make interest rates move higher, but for good reasons, not bad reasons. Better growth, higher interest rates because of better growth prospects is good for risk assets, is good for stocks, it's good for crypto, it's good for the economy, it's good for everything.
Steve Miran of Hudson Bay, as well as a fellow at the Manhattan Institute, PhD economist. Thank you so much for joining us today, for sharing your expertise, talking from knowledge within the Trump administration. Obviously, that is the previous administration. We hope that you're involved in policy going forward, and we look forward to having you back on. Please tell people where they can find your current work.
Thank you so much for having me. It's been a real pleasure to chat with you. My current work, you can sort of find it at our research tab at Hudson Bay Capital. For the papers and activist treasury issuance and restructuring the global trading system. Also a bunch of stuff on the Manhattan Institute website.
Steve Miran, thanks for joining us, and we'll catch you guys next time.
Thank you.